Welcome to the Leafy Podcast, helping real estate investors and entrepreneurs grow. Say hello to your hosts, Jennifer Glagoric and Brian Price, founders of Leafy Legal Services, teaching you how to protect your assets, grow your business, and manage your wealth. Let's start the show.
Hi, everyone. Welcome to Leafy Podcast. Thank you so much for being with us today. I'm Tammy, the podcast manager, and on today as the hosts are Brian and Jennifer, the CEO and COO of Leafy Legal Services. They have a wonderful guest on today with us, so I will go ahead and just pass it over to them so that we can get started.
Yeah, I'm very excited to talk to today's guest because he has a very interesting background. He created a nonprofit. That's how he started out, a Christian nonprofit in the San Diego area. And then as a way to try to build wealth and get capital, he stumbled in or researched, we're going to find out how, real estate, and now he's into syndication. Not only that, he has a very incredible podcast that he bridges the gap between entrepreneurship, business, and faith, called kingdomcapitalists.co. That's kingdomcapitalists.co. So everybody, I want you to give a great Leafy Podcast welcome to Ellis Hammond. Hey, Ellis, welcome to the show.
Hey,
Yeah,
welcome to the show.
Like a fun crowd. I'm excited to be
Absolutely.
a part of it.
We're gonna have some fun today. So why don't we get started and kind of tell your story, how you got into real estate, and maybe even how you got your podcast started as well with your nonprofit, and kind of give us your backstory, how you got into all this stuff.
Yeah, absolutely. And I hope it encourages for anyone who is trying to figure out, how do I start building wealth kind of maybe outside of my normal job, or if you're in the nonprofit world, you don't make any money. So how do you start, making money in in an environment where that's not the case at all? And the first time I just got hungry. My story is that we started a Christian nonprofit here in San Diego, and the goal for me was I was okay to be poor. I think for a long time, I was young. I was just wanting to make an impact. But as our ministry began to grow and we started bringing other people into kind of our movement and our community, I became responsible for not just myself anymore, but for other people. And so that's when I realized, to tell you the story, actually, a young man came to me who was kind of on our staff team, and he said, Ellis, I'm struggling to buy groceries this month. Wasn't really making enough money to be able to do that. And we had just done, we were in that kind of mode, or that part. We had just done kind of one single family deal here in San Diego that we were doing some short-term rental on to kind of start creating cash flow. But it was in that moment that I realized, like, I have got to begin to think about, think much bigger. Like, how do we actually build a business and create a model around, that could really generate income, that could generate wealth for us and the things that we want to serve. And so real estate kind of became that vehicle for me. And I'll tell you just one other quick story. The way I got started, very unconventional. I was driving the car and I heard a radio ad for like a fix and flip seminar or something. And they were like, how to build wealth through real estate. And I was just like, I want to learn how to build wealth. Somebody teach me. And so I went to the seminar, and, it was one of those things where, like, if you signed up for their course, they asked for this, and like eventually you sell your spleen or something like that. And then like maybe you buy a deal. Right. And I didn't end up doing the course, thankfully, but it was the first time that I looked around the room, and I just saw kind of normal people like myself, not incredibly well educated, don't have a lot of money, kind of a similar background, a stage of life, but they were really starting to build wealth and make money through real estate. And it hit me like, oh, wow, maybe you don't have to be the 1% to begin to build wealth like the 1%. And so that was really the start of us kind of getting into real estate.
I loved those mind shift stories of the aha moments where something happens and then you realize that the way you're thinking, the way you were taught growing up, or where you're at right now, that it's just opening up your mind to there's other ways to think about money and wealth and savings, and that the old adages that are hammered into our head, save every penny, or, you are greedy if you want to succeed. That's one. Those are all these. They're actually limiting beliefs, and that the rich don't necessarily think about money the way poor people think about money, and they use money in very different ways, and they're riskier in some ways, and they're more creative in ways that we think are very risky, but actually they're not. We've just been taught that.
Right. 100%.
So you talk about your passion is to help bring people and capital together in order to create major impact. Can you talk a little bit about how you're doing that now with multifamily?
Yeah, and kind of the way I got into that, I was raising funds essentially for a nonprofit. And so when that young man came to me, I was like, okay, like how... because we were doing the single family thing, right? And just realized like we had just bought a duplex here in San Diego and we did well, we're generating income off of that. But like to really seriously create legacy wealth, and I don't mean like, oh, when I die, my kids can, have money. No, I mean like, how do we create a legacy here now? Like what can we do at this current moment to begin to generate impact? And the single family route wasn't gonna cut it. I'm too big of a visionary. We had too much that we want to do in this lifetime before we die for that to go. And so I was like, well, I'm really good at raising money and I really like real estate and this is the way to do it. And so that was when I got introduced, and I don't know if it was through a podcast or Bigger Pockets or whatever it was, but I got introduced into the world of syndication. And I don't know, I know your audience is a little familiar because you just had, another great syndicator on with Wellings Capital.
Yes.
But, this idea of syndication was that you could actually leverage the expertise of someone else, and then you could put your money alongside another group of investors, and you could go take down a large asset that typically you would never, or someone by themselves would never be able to invest in on their own. But through a syndication model, you can leverage the operator, the expertise of that operator, pool your money with another kind of larger group of investors and be able to own an asset that typically was reserved for the 1%.
Yeah, I when we have talked to other syndicators, but I love that you're talking, we've talked to people at different levels. There are some like multi-million-dollar syndicators and others that are smaller syndicators. So tell me, why is it in the best interest of someone to diversify into multifamily real estate, and how much realistically would they need? And more important, so this is like 3 questions, I guess. And then how do they vet the people? Because, there's always this fear. You want to be with people like, and trust, who are trustworthy. So there's that as well. So can you touch on those 3 points?
Remind me the first question again, because I think I got the last 2.
What's in the best interest of investors?
Best interest, yes.
Yeah.
I mean, I was just talking with another investor today about that exact question. I mean, the likelihood of like real estate prices going down in value by 20% over the next 5 years is probably not as likely as the stock market going down over the next, by 20% in the next couple of years. And so I'm not saying that everyone should just be completely out of the stock market, right? I believe in diversification. What I help my investors see, because most of them have never heard of the syndication model, right? They know real estate is a good asset class to be in because of the benefits it has, the tax, benefits, depreciation you can write off. But they don't really want to do the small single family and how do you find a good deal, and you got to deal with, the tenants and the maintenance and all of that stuff. But the syndication model essentially allows you to be part of real estate, to own a piece of real estate, but from a passive standpoint. So the operator or the controller, right, they're managing the deal. They're putting the deal together. And you as an investor essentially just kind of get to place your funds alongside of that deal. And so I just think, like, for the sake of diversification, to be not so focused in the stock market and begin to kind of put some of that money, maybe while we're kind of experiencing this volatility, inside of an asset that historically has performed amazing in a recession, right?
Yes.
Multifamily
Typically does perform well in a recession. We know this from many experts. I'm just going to restate that again for our audience. Many of you come here from Bigger Pockets and for Connected Investors and other avenues. but it's because that people always need to rent. Now, what class you're investing in, that may change from
totally.
A, B, C,
and
D,
we don't have
whatever.
to do that today. So
yeah, but yeah.
That's the thing, right? So, I mean, it's just for the sake of my investors that I think for the next 5 to 10 years, like it makes a lot of sense for them to diversify some of those funds, kind of pull the gains that they've gotten from the stock market over this massive run of the last 10 years and begin to put that in a more stable asset like real estate, large commercial real estate, not talking single families. It's a very big difference, right? So we're talking 100 units or more typically in solid markets like Phoenix, Arizona, right? Like Charlotte, Raleigh, North Carolina, like Charleston, Greenville, South Carolina. Those are the markets we're focused in. So that's why it's in the best interest. As far as getting started, typically there's kind of 2 types of ways people will set up these syndications. There are opportunities, if you have, well, let me just say this. The minimum investment for most deals is about $50,000. So I would say, most sponsors are not going to accept funds less than that. And that's just because nobody wants to take someone's last dollars. And so, if you're not quite there, you're not making that type of money. I always tell my friends, like, if you can't put 30 to 60 grand away a year to invest in a syndication deal, take that money and put it back into your business and figure out how the heck do you go make enough money where you can put away 50 grand a year, right? Or go figure out a side hustle so that you can start kind of building up that reserve. Because if you could put away $50K a year into a syndication deal that's cash flowing 8 to 10% every single year, and all of that money, you can write off, because of the depreciation we're getting from that asset class, and then we can take that equity and we can roll it over into our next deal and not have to pay taxes on that. A decade from now, like you will replace, like your life will be changed. But you got to get to that point where, you can put away that 30 to 60K a year. So if you're not there yet, it's okay. Just double down on that. Don't worry about real estate investing. You're not there, right? So figure out a side hustle. Maybe go the fix and flip model. Like that's a way to create income. That's okay to do that at that point. So I always tell them that. And then I think your third question was the operator and how to really vet. This is probably what we should spend the most time on if people are interested in syndicating. This is the value that I bring to my investors, and that this is so, so important. And I don't think, like, if you're new to syndication world, you should realize this. In the last couple of years, multifamily has exploded, right? Because of the Jobs Act and, money from China and Japan. And there's so many syndicators out there now that and everyone has a deal, and everyone on LinkedIn and Facebook is celebrating their deal and their acquisition. So everybody looks like a rock star. Give it a couple years and we'll see who's really standing, because the things that are happening in the industry, the shortcuts people are taking, it's not going to be good. And so the tough thing is someone who maybe doesn't know about commercial real estate, right?
And they think it's a quick payoff. And that's
they see the numbers. Oh, you're promising 8%. Oh, you're promising 2x on my money. Great. Like that seems way better than the stock market. Well, it is while things are good. But there are a lot of moving parts, and I think people are trained to just kind of look at the numbers because of the stock market, right? Like, you kind of, your financial advisor, you're not doing due diligence on Apple, right? When you invest in Apple stock.
Right.
Right. But you should be doing due diligence on the operator and the man in the asset class that you're investing in. And so the value I provide is in my company, if you go to ellishammond.com, you can learn about this, but I essentially have a network of investors and we stay on the passive side, and I'm really vetting and kind of doing due diligence with a few key operators that are in good markets that I've handpicked that I really like. And when you're bringing in 50K, you can ask a few questions, but you don't have a ton of leverage. So, the idea is really pulling together or kind of really managing my network of investors so I can come to the table with a few million and be able to really do the proper due diligence that I think it takes to, take care of people's hard-earned money.
Yeah, that's really good advice. When it comes to doing your due diligence on an operator, what's some signs that you may want to look at that maybe someone's actually taking shortcuts that some of our listeners should be looking out for?
Yeah, I mean, here's a couple of questions I think you can ask if you're just going to go on your own. Just one of the things, ask for their track record. They should be able to have a list of like what they said the returns were going to be, and then where they are currently. Right. And so just ask her, hey, I'd like to see kind of where you said this project was going to be at and then where it's at currently. They should be able to provide that for you. And you should, if you're giving them $50K, that's an easy ask. So that's a great tip. I also I asked this question, and I think if people can get bold enough, they could ask this question too. Hey, really simple, right? This could really change the deal for you. So pay attention. Here's the question. If I were to run a background check on you, would anything come up? You should run a background check. But even if you don't, that question alone is really powerful.
Yeah, it is, because it makes people stop and people get worried, that, oh, I can't ask someone that. Well, yeah, you can. If you're going to invest $50,000 in it,
100%.
You can ask that. I know that I had to go through funding to start a business, and I'm going to tell you, when I'm out asking people to give me money, trust me, get money into my business, and I was looking for investors, they were asking a ton of questions. They were wanting to see everything, and it's their right to see it. There's some things, like if the personal questions, when it comes to that, see how they react to that. Right. Try to get on a call like this, a Zoom call or a Hangout or Skype, and get personal with them and want to talk to them with that when you're looking at partnerships.
Yeah, we're not talking about you're not looking for murder, right?
No,
you're looking for
or
do they have any tax liens against them, or are there any other financial burdens, or are there any other companies that went bankrupt? Because all of that stress or all of that pressure from all of that stuff, that could impact your deal, right? And so that's really huge. To answer your question, you want to get the legal papers, what we call PPM, which is what you'll sign. It kind of lays out the risk and the plan. I think that's really important, and you probably want to have a lawyer look over that for you, because you can change a lot of things in there that could benefit, that is more in line with the operator than the group of investors. And so I probably don't have time to get into all of that, but I would just say have a lawyer really look at that. You want to look at voting rights and, making sure the things that they had in the deal deck are actually in the operating agreement. So things like that, are really important. Or you could just ask them, hey, who is their syndication attorney, their SEC attorney, and make sure it's someone who's credible that they're working with. And then lastly, I just think this is so important. This is a mistake that I made early on, that I just, I'd love to share. And it's the operator, and we're not even talking about the asset, right? There's a whole lot of things that go into the market and deal itself, but we're just talking about the people involved, is who is actually managing the property itself. And so if it's not the operator, because most syndicators are going to use a third-party property management company, which I'm great with. I actually, most of the time prefer, because they're the expert in their industry. They know how to manage the deal.
Yes.
But do your due diligence on them. For me and my group, I go to the property, and if we're bringing in a new management company, I'll go do on-site due diligence of the other properties that they're managing, because you just want to know, what is their current condition of the properties that they're managing? How do they run their business? Some really easy ways to do that is just check with other vendors in the area, or go on Google and look at their reviews from the other properties that they own. Your operator should be able to give you that list of the other properties that this property management owns, or just Google their name, right? And so you could go to Google and just type in, on the maps, whatever, Willow Tree apartment, complex, and that should come up, and you'll see the reviews of what people said. So that's another thing I highly recommend.
And you should be doing that if you're doing buy and holds too, because pretty much, my recommendation is always get property management. Pay that 10%, get property management. And then if you get, we were just told this, and so I believe them because they're an expert. If you get over 100, 150 doors, then it probably would behoove you to start your own property management and to manage that. But these are things that a lot of people aren't taught how to do a background check or how to vet someone. And just because that company was great or had a great reputation 5 years ago doesn't necessarily mean it's the same company now. Companies switch ownership, Companies go through issues. Companies have, things that come and bite them in the butt from lawsuits that, that have derailed them for a little bit, that you can find out about. And is it always a deal killer? No, but you need to don't just rely on what you heard or what you believe to be true from 5 years ago. Even if you've done business with them before, it's still, you want to check up on it. It's kind of like your electricity. After a while, you want to check, am I still getting the best rate with this company,
Absolutely.
even though it's a pain?
Absolutely. Yeah, great advice.
No, that's great advice. So tell me a little bit about why do you feel that with the returns with this, is this something that people should look at once they first get that 50,000 to diversify in this? Why are you so, what are some other benefits that we probably haven't talked about yet into diversifying into multifamily?
Yeah. Well, like I said, if it's your first 50K, maybe I don't recommend it.
No, once they get,
But yeah, if you're established, I went to a buddy of mine. He's a financial advisor and, mostly deals in the stock market. And he kind of uses this example and he said, and he was using this in the sense of, actually trying to sell his clients with this. And I was thinking to myself, this is actually not good. So he used the example of like most financial plans are kind of built around this idea of like getting to, your whole life, you're trying to climb to the top of the mountain. Right. And so this whole idea of wealth creation is kind of getting to the peak of the mountain. And what he was helping his clients do is his whole sell was no one really talks about how to get down the mountain, right? In the sense of how do you actually distribute that kind of nest egg that you've gotten. Well, I just totally disagree with that premise completely, because why do I want to spend my whole life focused on how to get down the mountain? Right? Like I'm wasting the best years of my life worried about, do I have a big enough nest egg? Right? Like that is just against kind of my values in the sense that God has placed me on this earth and I want to get as much value and leave as much impact as possible with everything that I have. And so, I believe in cash flow. Instead of trying to build this massive nest egg, focus on cash flow in the sense that how much, so the thing about multifamily is that, it's creating a cash flow distribution for you so that you can actually begin to find some freedom before you reach the summit. You don't even need to get to the summit anymore to begin to create more freedom in your life so that you can actually focus on the things that can create the most impact. And so if that's outside of your W-2, maybe that's with your family or with your nonprofit or with your church, this can actually allow you to have some freedom in what I would say the prime years of your life, right? To have some freedom to really live out that impact, to spend more time with your family. And so, yes, there's other benefits like tax benefits and, bonus depreciation. And because of the depreciation we can write off, a lot of that income in the first year, you don't even put on your taxes. There's all of that. But the biggest thing for me is I try and tell my investors, like, forget the mountaintop. Like, let me help you try and create some margin in your life today so that you can really live out the calling that God has for your life. And so that's, for me, that's why I love multifamily, because it allows me and my group of investors to be able to do that.
Yeah, I love that model. Is a lot of times, they talk about, I've heard it as the pile of money model, whereas you earn enough money so that you can live off the interest. The problem is by the time you're done building the mountain, there's not much you can live off of. So.
That's not promised, right?
No,
that's not promised.
Exactly. That's true. And so, I like the cash flow model is building something that, brings money in on a regular basis. So you're actually able to enjoy it while you're building it too.
Exactly.
And it's hopefully it's perpetual past you as well. Right. To build a legacy for yourself.
Yeah, that's the beautiful thing, right? Is like, you don't have to trade it. You don't have to trade cash flow for appreciation, because yes, you're getting cash flow from, the tenants who are paying down, they're who are essentially paying rent each month, but you're also getting the equity, the appreciation. I'm sure your listeners, or you've talked about how, commercial is different from single family in the way that value is created. But the more that we can increase the revenue in the property, the more the equity in that property can grow. And so, we're getting not just cash flow, but we're getting kind of that long-term, legacy type wealth that, is important for people and you should be thinking for, I'm not saying, so you don't have to trade is my point.
Yeah, it's not one or the other. Mm-hmm. Okay, guys, we're here. We've been talking with Ellis Hammond. A lot of deep stuff here. We've been giving you the mile-high overview of a very fascinating way that you can diversify your real estate portfolio into syndication and multifamily. If you want to hear more, please go to ellishammond.com or listen to his podcast at kingdomcapitalists.co. That's Kingdom Capitalists with an S at the end of capital .co. Is there anything at all that you want to add for our Leafy listeners before we go?
No, I think that's it. I always, people ask me kind of my best advice, and I think the best advice I would give is know what your superpower is, right? Like know what you're good at. I'm a real estate entrepreneur, but just, because real estate is a great asset class to be in, doesn't mean you have to be focused on real estate. If you really love and you're good and you enjoy something else outside of real estate that can make money, double down on that activity and then leverage the expertise of somebody else, to really create wealth or create cash flow or whatever. But I think, and I tell everybody, focus on your superpower, the thing that God has called and gifted you to do. And don't so much worry about becoming this real estate guru if that's not you, because I'm telling you, you'll be more successful in the long run doing that. So that's all I would add.
Yeah, we could do a whole show just on that.
Yeah.
That's a good one. Focus on your superpower. Okay, well, it was just really a pleasure to have you on today, Ellis.
Yeah, thank you so much.
Yeah, and Tammy, take us away.
All right. Thanks again, Ellis, and thank you, Jennifer and Brian, for being our hosts today. I will have all of Ellis's links in our show notes so that you will be able to find him, find his podcast. And if you do have any questions for him, please feel free to find him at his website, but also you could email me if you would like, and I will pass on the questions. My email is Tammy, Tammy, at leafylegalservices.com. So feel free to shoot me a message about a comment, or if you have another recommendation for the show, I will write right back to you. So thank you again for listening today. We had a wonderful time. I hope you did as well. And if you would like to look us up on social media, we are everywhere at Leafy Legal. So have a wonderful day, and we will see you next time. Thanks again.
Bye.
Attention real estate investors and entrepreneurs. Did you know that real estate investors are a primary target for lawsuits? According to the National Survey of the Court data, 25% of Americans risk being sued in their lifetime. However, if you are a real estate investor, you have a 95% chance of being sued in the next 20 years. Leafy Legal Services helps you protect your assets and strategically grow your business and wealth. Leafy Legal Services are experts at the Series LLC and Delaware Statutory Trust, two of the newest and most ideal legal structures for real estate investors. Leafy Legal Services have the most personalized and affordable solutions for setting up LLCs. Property owners are always at risk when it comes to their assets. Anonymity is so important. If you own just a rental house and you own your home, you have to protect yourself and your properties from any potential legal issues. Leafy Legal Services have the right solutions to make sure you are happy and feel secure. They offer cost-effective documentation that suits their clients' needs. For a free consultation and ebook, visit leafylegalservices.com. They are waiting to hear from you. leafylegalservices.com.
Follow us on Facebook, Twitter, and Instagram.
Don't wait. Take action now. LeafyLegalServices.com. Protect your assets, grow your business, and manage your wealth.